Welcome to the TAC Index AI Podcast Weekend Edition, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. Today, we're embarking on a true deep dive into some fascinating and really interconnected updates across global logistics and the broader macro market. We've pulled together a pretty compelling stack of sources for you. The very latest air freight market data from TAC Index, some crucial reports on significant trade negotiations involving the U.S., China, and India, and a look at some truly historic developments brewing within the U.S. Federal Reserve.
Yeah, and these aren't just separate headlines you might skim in your morning brief. When you actually connect the dots, you start to see how these subtle shifts in air cargo rates can create immediate ripples right through complex supply chains.
Right.
And how major trade policy decisions directly influence global economic flows and, well, how the actions of a central bank can impact pretty much everything. From your personal consumer spending right up to the cost of shipping goods across oceans, it's all incredibly interwoven.
Exactly. So our mission today is, well, let's unpack the current pulse of air cargo, try to understand the latest twists and turns in global trade talks, and explore what really is a rare moment unfolding at the U.S. Fed. By the end of this deep dive, you should walk away with a much clearer picture of these dynamics and, crucially, why they matter directly to you. All right, let's kick things off by really unpacking the air cargo market. Specifically, what the latest data from TAC Index, a leading price reporting agency for air freight, what does that tell us? What's the overall picture looking like this past week? And maybe where are the real surprises?
Well, a key takeaway this week is that global air freight prices were largely unchanged overall, but, and this is key, that top-line stability really masks considerable variation across the major lanes around the world. The overall Baltic Air Freight Index, the BAI0, it actually edged marginally lower by just 0.4% week over week.
Okay, a tiny dip.
Tiny dip, yeah, which leaves it down about 1.9% year over year over the last 12 months. So like you said, a slight global dip, but the real story is truly in the regional differences.
Yeah, that slight dip globally definitely isn't the whole story, is it? So where are we seeing the most interesting, maybe the most telling movements, on the ground?
If you look closer, the busiest lanes out of China tell an important part of the story. Rates from Hong Kong, that's the BAI 30 index, they gained 0.3% week over week. Now, it's still down 6.7% over the last 12 months, but that upward movement, however small, is noteworthy.
Mm-hmm.
And similarly, outbound Shanghai, the BAI 80, also edged up slightly by 0.2%. Wow, W. Still lower year over year, about 3.7%. But these modest gains from China, they suggest a definite, albeit slight, pickup in demand from these really crucial Asian manufacturing and export hubs, maybe hinting at renewed consumer interest or some inventory restocking.
And it's particularly interesting how those regional variations played out. It certainly wasn't like a uniform trend across Asia, was it?
Oh, absolutely not, no.
Yeah.
While China saw those small gains, other parts of Asia painted a really mixed picture. For instance, rates from Vietnam were actually rising to Europe, which indicates strong demand for goods heading that way. But at the same time, they were slipping, going down to the U.S. And conversely, rates from India did the exact opposite,
right,
rising significantly to the U.S., suggesting increased American demand for Indian goods, but falling to Europe.
Huh.
This kind of divergence, it really makes you think about specific demand drivers or maybe supply factors that are unique to individual trade routes. It just showcases the granular complexity of global trade.
Right. And stepping across the continents, what about Europe and the U.S.? Any surprising facts or shifts there that stand out?
Well, from Europe, we saw rates rising again to North America, but kind of paradoxically, falling to China and Japan.
Mm-hmm.
And among some of the newer lanes they've recently added to the data, rates were climbing to Australia, Brazil, and South Africa, yet again, paradoxically, falling when shipping to India.
Wow.
Maybe the most striking aspect in Europe, though, was the Frankfurt Index, the BAI 20. That gained a healthy 4.0% year over year.
That's a big jump for Frankfurt.
Yeah, it is. And that surge in Frankfurt, which is, a major hub for high-value manufacturing pharmaceuticals,
Mm-hmm.
it could signal companies prioritizing speed and reliability through those central European gateways.
Mm-hmm.
But then London, the BAI 40, gave back a significant chunk of its recent gains. It shed a substantial 16.4% week over week.
Whoa, 16.4% down.
Yeah, big drop. Though, importantly, it still shows a robust gain of 17.7% YoY over the past year. So maybe some rerouting of certain types of cargo or shifts in specific product demand. Hard to say for sure yet. And from the U.S., Chicago, BAI 50, that gained a strong 6.7% YW on lanes to China and South America, but fell on routes going to Europe. That leaves it lower by 3.8% year over year.
Okay, so there's a lot of push and pull there. If you're trying to make sense of this really intricate web of data, what does this all mean for you, the listener, whether you're running a business, an investor, or just trying to keep an eye on the global economy?
What this data truly reveals, I think, is the ongoing strategic reevaluation that's happening within global logistics and supply chains. These specific lane movements, they aren't just numbers on a page. They indicate shifting trade patterns, regional demand fluctuations, and supply chain adjustments happening, pretty much in real time.
Right, real-time indicators.
Exactly. So for anyone tracking global commerce, these granular details are absolutely crucial for understanding where goods are moving and, crucially, at what cost. It gives you a tangible sense of the underlying economic activity. It's like a constant dance between demand capacity and the push and pull of global commerce.
Okay, so moving from the sort of nuts and bolts of air cargo rates, which, as you said, are a direct indicator of economic activity, let's pivot a bit to the broader macro market. We should probably focus specifically on the ongoing global trade tensions because those can absolutely have a ripple effect on the very rates we just talked about. So first up, the U.S. and India.
Yeah, a key takeaway here is the palpable uncertainty surrounding the U.S.-India trade deal. President Trump made a very clear statement that the deal has not yet been finalized, and he warned of possible higher tariffs, potentially in the range of 20–25%.
20–25%. Wow.
Yeah, and all ahead of a looming August 1st deadline. That's certainly a strong bargaining chip being put on the table.
That's a pretty strong statement, yeah. Sets a firm tone. So what's India's position in all this, given their significant economic growth and, their global aspirations?
Well, stepping back to look at the bigger picture, Indian officials have indicated they plan to resume broader trade talks in mid-August. Their ambitious goal is aiming for a comprehensive bilateral agreement by October. But, and this is important, there are significant no-go areas for India.
Ah, okay. Like what?
Specifically agriculture and dairy. Those remain highly sensitive sectors where they seem unwilling to allow U.S. imports of, say, genetically modified soybeans or corn. Nor are they prepared to open their crucial dairy sector to U.S. competition. This indicates a pretty clear line in the sand for them.
Understood. And what are the real stakes for both countries in these negotiations, especially with such specific sticking points?
Well, this leads us to consider the sheer volume of trade involved here. Total bilateral goods trade between the U.S. and India, it reached roughly $129 billion in 2024. And India actually posted a significant trade surplus of nearly $46 billion.
$46 billion surplus for India.
Yeah. So the potential impact of these threatened tariffs on that substantial trade flow is, well, it's immense, particularly as the U.S. is also threatening broader tariffs targeting the BRICS nations. That's Brazil, Russia, India, China, South Africa, which of course includes India. It just adds another layer of broader geopolitical pressure.
Right. Okay, now let's shift our focus to the perhaps even more complex relationship, the U.S. and China. There was that critical 90-day tariff truce put in place. What's the very latest update as that deadline gets closer?
A significant update is that the truce, which is set to expire on August 12th, it saw U.S. and Chinese officials agreeing to seek an extension. This was after what they described as constructive talks in Stockholm.
Constructive, okay. But any breakthroughs?
Well, that's the thing. No major breakthroughs were announced. And U.S. officials made it quite clear that President Trump retains the final say on any extension. So while talks are ongoing, the ultimate decision really rests with one person.
So we're still very much in a wait-and-see mode then, with the specter of tariffs potentially shooting right back up to those, frankly, intimidating triple-digit figures. What are the broader implications if an extension isn't granted, if those tariffs truly rebound?
Yeah, it really begs the question of how global supply chains and financial markets would react. They could indeed face renewed turmoil. The International Monetary Fund, the IMF, has even flagged a potential rebound in tariff rates as a major risk to global growth. That underscores the potential severity here. And it's also important to remember that China holds considerable leverage with its grip on the global market for rare earths and magnets. These are absolutely essential in everything from military hardware to electric car components.
Critical components, yeah.
Critical. A disruption there could have really far-reaching consequences, echoing right back to those air freight rates we discussed earlier, if those components suddenly face new barriers or, significant extra costs.
Right. So beyond just tariffs, which tend to grab the headlines, what are the fundamental underlying economic issues actually being discussed in these high-stakes negotiations?
Well, the U.S. is strongly emphasizing the need for China to shift away from its current model, the state-led, export-driven manufacturing economy. shift towards one powered more by increased consumer demand domestically. This, in theory, would significantly boost U.S. exports into China.
Okay.
There have also been discussions on bringing down the retaliatory tariffs that China has imposed and, crucially, addressing tech export controls, things like those impacting NVIDIA's H20 AI chips, which are vital for advanced computing.
Right, the AI chip controls.
Exactly. And interestingly, President Trump also mentioned he thinks he will meet with Chinese President Xi Jinping before the end of the year, which, if it happens, would be a significant development in itself.
Definitely. So, for you, our listener, trying to navigate this complex landscape, what does the outcome of these ongoing trade talks genuinely mean for your everyday life and maybe your broader economic outlook?
Well, the outcomes directly impact the cost and the availability of goods you consume every day, from electronics to clothing, you name it. They also significantly influence the stability of global markets and the overall worldwide economic outlook. These negotiations they're far more than just discussions about tariffs. They are fundamentally about shaping the future of international commerce, global competition, and ensuring that those crucial supply chains remain fluid and efficient. Understanding these dynamics really helps you anticipate economic shifts.
Okay, finally, let's turn our attention right to the heart of U.S. monetary policy, the Federal Reserve. We're apparently witnessing something at the Fed that hasn't happened in decades, possibly signaling shifts in the financial landscape. This is where it gets truly fascinating, I think.
Yeah, one really striking aspect we're seeing is the possibility of more than one Fed governor dissenting at this week's policy meeting. Now, this is a situation we haven't seen since 1993. That's a remarkable streak, including 259 policy meetings where consensus largely prevailed among the governors.
259 meetings. Wow.
Right. And now Governors Christopher Waller and Michelle Bowman, who are both appointees of President Trump, they've quite publicly voiced support for cutting rates, which aligns, perhaps coincidentally, perhaps not, with Trump's public demands for such cuts.
So these aren't just, any old dissents. They carry significant historical weight. What exactly is driving their potential break with Chair Powell's more cautious sort of wait-and-see approach to monetary policy?
Well, if we zoom out to the bigger picture, like Michelle Bowman actually broke a 19-year streak of no Fed governor dissents way back last September. She opposed a half-point rate cut then, specifically warning about persistent inflation.
Right, I remember that.
Then she supported quarter-point cuts in both November and December. Now, Christopher Waller followed suit with his own dissent back in March, and he's notably argued that the Fed shouldn't overreact to price increases caused by tariffs, viewing them as temporary, and that the labor market isn't as healthy as it maybe looks on the surface, thereby warranting rate cuts this week. Their arguments represent a pretty clear divergence in economic philosophy.
And there's an undeniable political dimension to this too, isn't there? With President Trump intensifying pressure and potential successors openly kind of jockeying for position ahead of Powell's term ending next May, it just adds another layer of complexity.
Indeed it does. Dissents by Fed governors were actually much more common back in the 1980s under President Reagan. But the Fed has consciously evolved towards fostering greater consensus building over the past few decades. This current situation genuinely threatens to end that era of, let's call it, institutional harmony. And while Waller frames his dissent as principled, based on his economic view, some observers also see it as potentially a strategic move to keep his perhaps long-shot candidacy for Fed chair viable. This internal dynamic isn't just academic. It really influences the stability and the perceived independence of the institution itself.
So what does this rarely seen internal dynamic at the Fed mean for you, the listener, whether you're planning a major purchase, managing investments, or just trying to understand the economic winds?
Yeah, well, this leads us right to consider the future direction of interest rates, which, as we know, directly impacts everything from mortgage rates and loan costs for consumers and businesses right through to investment returns. It also speaks to the foundational independence and the internal dynamics of the Federal Reserve itself, which ultimately shapes the entire economic environment in which businesses operate and, individuals like you make financial decisions. Understanding these internal tensions and these differing viewpoints, it helps you gauge potential shifts in monetary policy, which allows you, hopefully, to anticipate and adapt your own financial strategy.
What an incredible deep dive that was. We've really spanned the globe today, from those nuanced shifts in air freight rates like Frankfurt's surprising gains and London's unexpected drop, right through to the high-stakes trade negotiations with India and China, grappling with everything from agricultural imports to rare earth minerals, and finally exploring the very unusual internal dynamics shaking up the U.S. Federal Reserve. A really rare moment we haven't seen in, what, decades?
It truly highlights how incredibly interconnected our world is, doesn't it? The seemingly small price fluctuations in moving goods around the planet, the complex agreements or sometimes stubborn disagreements between nations on trade, and the monumental decisions made by central bankers. They all feed into the same vast, complex global economic system. Each piece of information, really, from a fractional shift in a freight index like we saw, to a major descent at the Fed, it all contributes to this larger, intricate tapestry.
Absolutely. I think the aha moment here is really recognizing that these seemingly disparate headlines we see every day are all deeply interwoven threads in that very same tapestry of global commerce and stability. It's about trying to see the whole picture.
Exactly. So here's a final provocative thought for you, the listener, to consider. In an era of increasing geopolitical tension and, let's face it, economic uncertainty, how much will the willingness of key figures to break ranks, whether that's in contentious trade negotiations or within the traditionally consensus-driven world of monetary policy, how much will that fundamentally redefine the global landscape? And maybe what unexpected ripples might those disruptions create for the very flow of goods and capital around the world? Something to think about.
A great question to end on. Thank you for joining us for this deep dive. Until next time, keep digging into the data and connecting those dots.